This is Chapter 8 for Intermediate Accounting and Recovering Inventory, the perpetual and periodic methods for FIFO and weighted average. When the weighted average method is used in a perpetual method, it's sometimes called the moving average. To start off, here's a list of the information about the date, the activity, purchase, sale, etc., as well as the beginning inventory balance, how many units, the unit cost, and the sales price. I suggest you put this on a spreadsheet. My initial spreadsheet just started off with this basic information. So that's sort of the beginning point, and then I'll organize it from there. So you'll see here, I've expanded and started to organize some things. I put the beginning inventory and the purchases at the beginning, and then I kind of put a line and put the sold things on the right. I also added a column for total, and I did the total for the purchases and the total for the sales. So you've got your total here, which is 150 units times $5 a cost, gives you $750. I did the same on the other side. Just notice that I have it as S price for the sales price. The other thing I did was put column totals, because we want to make sure we keep track of how many units we have. And one of the things we're going to do here is be able to account for things in units and in dollars. So what we end up having is 2,400 units. If you remember your accounting rules for the cost of goods sold, its beginning inventory of 150 plus purchases is going to get me 2,400. So I happen to know, right, just from the simple math, that 2,250 must be my purchases, because 150 beginning balance will give me my 2,400 total. The same thing for total here. This is the total available for sale. And we sold 1,650. Now, one of the things you can notice here is if I have 2,400 units available and 1,650 are sold, then what I really must have is I must have 750 must be left in ending inventory. So I've got some kind of just beginning things I'm dealing with here. And then this number here is going to be my total sales price. So things you really need to know inside out, upside down, backwards is the cost of goods sold section. I did this as a goods sold, so I could deal with the units here in one column and the dollars here. So it would be units sold on the left, but cost of goods sold on the right. So you've got your beginning inventory of 150 units or $750. We purchased the 2,250 I just mentioned, so we ended up with 2,400 units available for sale. Our purchases cost $11,780, so we had in cost $12,530. If you remember the cost of goods sold, we subtract out ending inventory and get to goods sold. My preference is actually that you keep it that way and you plug for the missing number, because what you end up doing, if I have 2,400 available and 1,650 were sold, then I know that I have 750 units in ending inventory. I merely put it down here as an easy visual reference. We didn't put anything over on the dollar side because we've got to figure out the cost, and that's going to depend on which method we're going to use. If we're dealing with the periodic method, this is going to take care of it once, and we're only going to analyze our inventory once. First in, first out says the last 750 items into the store were the ones in ending inventory. So our last purchase was of 600 units on October 17th. So 600 units at $5.40 a piece meant we spent $32.40 on October 17th on inventory. But we're still 150 units short because we need to make sure our ending inventory is 750 units. So I have to go to the previous purchase. The previous purchase was 350 units, but I sold some of those. I only need 150 from that, and at $5.30 a piece, I have $795 there. So my total units is 750 units, and my total cost of my ending inventory is $4,035. Now you'll also notice at the top, I mark that periodic is equal to perpetual. That's only with FIFO. It doesn't happen with LIFO. You've got to do a separate perpetual calculation. The reason it happens with LIFO is we're saying the last stuff in is the first things out. So as time goes by, we're going to still keep our most current purchases and sell the older ones. So it would be impossible for us to not have the October 17th purchases of 600 and the October 13th of 150. It'd be impossible for them to not be in our ending inventory. Once we get the calculation of ending inventory, don't stop. Often students think, oh, that's the number, and they throw it in their answer and don't bother reading the question. What were you asked? Were you asked how much is an ending inventory? If so, you're good. Were you asked for the cost of goods sold? Well, we know from the calculation page that $12,530 was our cost of goods available. If we subtract ending inventory, you end up with cost of goods sold of $8,495. The next is the weighted average. And we're going to do this first in the periodic method. It's the same calculation for the perpetual, you just have to do it over and over and over again. And the idea, we look at goods available, and we have 12,530 units, or $12,530, and we had 2,400 units. That says our average cost is weighted by our purchases is $5.22 per unit. Well, if we know that it's $5.22 per unit, and that we have 750 units, our ending inventory is $3,916. And that proves itself here. We're going to start with the cost of goods available, and if you're doing the periodic method, you'll notice that they're the same. Well, they should be. So goods available at 12,530, less ending inventory of 3,916 means your cost of goods sold is 8,614 using the weighted average periodic method. Of course, those are easy. Now, if you can understand how to reset these for the moving average in the perpetual, which is the weighted average with the perpetuals called the moving average. If you can do that here, and you could understand this, and you forget that FIFO perpetual is equal to FIFO periodic, you would actually do the same kind of theory. You do after each purchase and sale, and you'll prove it to yourself that the FIFO periodic is the FIFO perpetual. And if you understand that, you could follow the same philosophy and do LIFO if you're being taught LIFO. I personally think that if you understand how to do this moving average perpetual, you've got that mind expanding situation to understand how to calculate these, and it all comes back to play that you'll understand how to do LIFO should you have to. Now, you'll notice I've added a couple extra columns here. I've added cost of goods sold and cost of goods available. And that's going to help me keep my inventory numbers. So you'll notice I've got C's there for the costs. Other ones you're going to deal with a little bit differently. You want to make sure you're keeping track of your units. and this you could have as $ for total cost. So if I have 150 units at $5 a piece, I have $750 in that by beginning inventory transaction. I also have nothing sold and 750 of my goods available for sale. The reason I want to do that is because I want to keep track of my goods available for sale at that moment, divide by the number of units, and calculate my moving average. So I have 750 divided by 150 is going to give me $5 per unit. Carry it out to 4 decimals. Next time you makes a purchase, what happens is 750 units were purchased at $5.10. That leaves you with $38.25 in that transaction. One of the other things you want to pay attention to is keeping track of your layers. So you end up, you didn't sell anything in between. So your available beginning inventory is also available here. So you end up with 350 or 750 units, dollars available, and 150 units. Then you have your purchases of 150. So these are kind of shown here just to keep them separate. You've got 3,825 leaves you with 4,575 units. You also added another 750 units to the 150, so you have 900. So your moving average is now 45.75 divided by 900. Your moving average is $5.0833. Okay, I just moved up the previous activity so we could see everything clearly, and we're going to go ahead and record the sale. This time we've got a sale. There's 350 units. When it comes to unit cost, the unit cost is exactly this weighted average we just calculated. So 350 times 5.0833 says my cost of goods sold for this activity, $1,779. Now, if I had 900 units and I sold 350, I must have 550 units left. And I could look at the costs different ways. Cost of goods available, my ending inventory that I just sold is no longer available. So 45.75 minus 1,779 leaves me with 27.96 available. And now I can take the 27.96 divided by 550, and I'm going to prove that I'm still at 50833 because I didn't buy anything. So my weighted average of the cost of the unit didn't change. I've just eliminated some of them. So next thing, we have a similar sale as well. Same thing happens. This time we have 250. We know that we're dealing with the 5.0833 gives me my total for the activities, but doesn't change anything. That number is going to be 1,271. So putting it in that column for the total of the activity is helpful, but I may as well put it directly into cost of goods sold. Then I've got cost of goods available. 27.96 was what's available. If I subtract out the 1,271, I end up with 1,525 units. The same thing, if I take my 550 units that I had available, subtract out the 250 that are sold, and I'm left with 300. If I have $1,525 that are available for goods and I have 300 units, I end up with $5.0833 in my weighted average or my moving average cost. So the next thing that happens is we bought some more. Well, my cost of goods available, or my numbers are still there. So I still have the $1,525 and 300 units. I'm just adding more items to them. So I bought 550 units. So 300 plus a new 550 means I have 850 units. I just paid $2,860. So that's in addition to what I had available. I have more available. So I end up with $4,385 in goods available. That's the $1,525 plus my new purchases of $2,860. And I end up with a total of $4,385 in cost of goods available. I divide that by my 850 units available. Now my moving average is each unit's $5.1588. So moving on, we ended up with a new sale. And this new sale was 250 units. The unit cost was the 5.1588 that we had as a moving average. So our cost of goods sold for this sale is $1,290. Cost of goods available, if I had $43.85 available and I just sold $1,290, my goods available are $3,095. And if I have 850 units available and I just sold 250, I end up with 600 units. So if I take my $3,095 divided by my 600 units, I prove that I still have $5.1588 as my moving average. Remember, when you sell, your moving average per unit does not change. It only changes when you buy. So when you sell, you end up with a proof that that's what you're left with. So the next thing happens is I buy some more. My inventory before the purchase was $3,095 made up of 600 units, but I ended up buying 350 more units. So 600 plus 350 gets me to the 950 units. I had 3,095 goods available. I just spent $1,855. So my goods available, my total is now $4,950. If I divide the goods available of $4,950 by the 950 units, I end up with a new moving average of $5.2108. I feel bad if this repetition is getting to you and you understand it, that it just tends to be tedious. But hopefully you're getting a little better at it each time. So now we have a sale. On October 15th, we sold 500 units. Our cost is the 5.2108 that we said was our moving average. So our cost of goods sold for this particular sale is $2,605. If I had $49.50 and I just available and I just got rid of $2,605, my new goods available is $2,345. If I ended up having 950 units and I just sold 500 of them, I now have 450 units left. So my goods available of $23.45 divided by my 450 units will prove that my moving average is still $5.2108. So now we have another purchase. If we had 600 units that we bought at $5.40 a piece, the total of our purchase is $32.40. Well, our cost of goods available was $23.45. We carried that down from the prior transaction. We're going to add the $32.40 and we end up with a new goods available of $5,585. We end up with units. We had 450 units that we had after the last sale. We're going to add the 600 units that we bought and we ended up with 1,050 units. If our goods available is $5,585 and we divide that by 1,050 units, we end up with a moving average of $5.3189 per unit. The last transaction is a sale of 300 units. Well, we know that we've said that the moving average is 5.3189 times the number of units is going to give me cost of goods sold of $1,596. If my goods available is $5,585 and I just used $1,596 in my units sold, I end up with the final goods available of $39.89. I also have 1,050 units and I just sold 300, so I end up with $750. And when I divide those out by my cost of goods available by $39.89 divided by my 750 units, I end up with a moving average of 5.3189, or I prove that that's my moving average. The interesting thing about this for your last set of numbers is that what you end up with available on the last day of the year is your ending inventory, because it's available for sale and it's not sold, so it has to be your ending inventory. So if we start again with 12,530 as goods available, subtract out what's available at the end. Now, this is the moving average perpetual weighted average. So that's the only way this works. We end up with $39.89 as ending inventory. That leaves you with cost of goods sold totaling $8,541. And if you total everything in this cost of goods sold column, you will also get $8,541. Finally, look at what happens in the effect on income. Each method's a little different. If you use FIFO, you end up with sales minus your cost of goods sold gives you a gross profit. You end up with $5,050 as your gross profit. If you use the straight weighted average, your gross profit's a lot higher. If you use the moving average, it's a little bit lower, $5,004. And the only reason I had a separate column here is just again to mention that FIFO perpetual is the same as FIFO periodic. Feel free to go through it and do the moving numbers where you have to recalculate FIFO each time, and you'll also prove that your ending inventory and gross profit and cost of goods sold are all the same under perpetual as under periodic. That's the end of this example.